Okay, we're recording this video on Sunday, the 27th of December, 2020. A Merry Christmas and a Happy Hanukkah to you. I do hope you are doing well. And I hope all 10,000 subscribers to Emini-Watch are doing well, because this has been some pretty crazy year. Now, I am struggling to record this video. There have been various number of starts and stops to it, but I'm just going to power through kind of whatever happens. Got some thoughts on kind of the psychology of trading and dealing with what is going on to talk about. But before doing that, let's stick with something that I'm more comfortable with, which is talking about the charts and the markets. So I'm going to pull up my global macro charts. So here we go. There's two screens of these. The first one is all the major asset classes on one screen here. 9 of those I look at. And this is the major Forex contracts. I count Bitcoin as a Forex kind of contract, but it can be viewed as an asset too. But anyway, so 9 of these as well. Looks pretty squishy on a small screen here, but on a big screen, my 16-inch MacBook Pro, it looks fantastic with all the colors here. And all I've done is put Better Pro-Am on these charts. I like Better Pro-Am more and more. It allows me to screen out trades and only trade after there has been professional activity. I find that narrows down the number of opportunities that you need to look at in your trading, and so I find it incredibly helpful. Better Pro-Am is unique. I don't think anybody else is doing this, but it's using average trade size to identify professional and amateur activity. And again, as I say, I can't believe no one else is doing this because it's pretty handy. Anyway, so Better Pro-Am paints professional activity with blue bars that you can see here and here, and amateur bars in yellow here and here. I also add in this extra pattern, which is called a Rambo pattern with a little R above the bars or below the bars. If the move is being led by the amateurs, it can be suspect and kind of fall back. And that's what I call a potential reversal of an amateur breakout, and that's where Rambo kind of comes from. So all I've got here is what the professionals and amateurs were up to over the last year on each of these markets. In terms of the asset classes, there's 3 stories going on. One is kind of the risk-on, risk-off kind of activity, driven particularly by the equities, or seen particularly in the equities charts that you can see here. The second one is kind of the reflation, inflation kind of trade that you can see in the commodities markets here. And then lastly, there's the money printing by the Fed kind of story that you can see in the gold and also the Bitcoin chart on the Forex chart over here. But let me just show you that just briefly on the E-mini chart. So for 2020, this is what was going on here. We had into December of last year and January, the move was being led by the amateurs with Rambo patterns. So for me, that's always a little bit suspect. And then on this little dip, we had the professionals step in where they force the market up. They take profits, they start getting short, and as soon as we're through the lows of those blue professional bar, we've switched into a downtrend, and we have this waterfall decline February, March here, and then kind of bottomed. And then it was a V reversal after that. Bang, we hit that bottom pretty hard, and then we kind of bounced out of that. And then as soon as we kind of broke to new highs, that was being driven by the amateurs as well, with more kind of Rambo patterns here. And then we just had some weakness from there. Interestingly, in this last move up into December, also being driven by the amateurs here. So that for me is a little bit of a warning sign. But let's wait and see. We need to be dropping through supports on a daily time frame before there's anything, kind of confirmed here. But it's just a little early warning signal there. So that was the E-mini chart. We saw a similar thing on the emerging markets chart here. So we had the waterfall decline. We had some blue professional bars kind of into January up here, and then we fell off. And then into those new highs, Rambo patterns, some weakness after that. But then we've kept on powering through here on the emerging market side. High yield growth. So this is junk bonds. Again, massive. This was a big move down in the junk bond market. So same thing, amateur bars in December, move up with blue professional bars, and then here, bang, on the way down. And we've not cracked to new highs for the junk bond market, but we're kind of testing back up to there. The weakest of all of these kind of risk-on trades has been real estate. Here, same thing. Big decline, and then we've only kind of come back to, let's say, half of what the move was. So we're kind of fussing around here, and that's no kind of surprise really. The commercial real estate market's going to be very weak, and we're going to see, have some trouble next year as we see things kind of play out there. So that's kind of the risk on story. The risk-off story is the inverse of that, which is the bond market. And so we can see coming into December, January, we see the bond market was kind of weakening. But this move down here, amateur down bars, so always look for those as a potential area where the amateurs are thinking this will break into a downtrend. They get it wrong and it kind of rallies the other way. So a little bit of weakness there, and then we kind of, as soon as the markets kind of fell apart, everybody rushed into bonds, kind of the safety trade here. But ever since that peak in, what is that, end of February here, it's just been down for the bond market. It's been very kind of boring trade in the bond market kind of all year, except for in December. December, on this weakness, the blue professional bars have stepped in. And this is one of the setups I like. When we get a stair step here with this trailing stop being brought up every time we see blue professional bars, if we have a decline into there and you see the blue professional bars and the stair step support or resistance, if we're going the other way, kind of comes up to meet that, that is a good indication of a place where we might be interested in a trade. What we're looking for is a break above the highs of those blue professional bars, and then you can keep your stop really tight underneath this support and keep the risk to the minimum here. So I like that for a setup of a trade, but it needs to show some strength and get them up above those blue professional bars to be confirmed. But for me, that's pretty interesting because we got this amateur move, Rambo patterns on the equities market to new highs up here, with the bond market, and the professionals might be stepping in to buy that little weakness at that point, and so we could have another risk on, risk off type situation here. So there we go. That's 3, 4, 5 of those charts. Then let's talk about the commodities market here. So again, into December 2020, Rambo patterns on crude here, and then we fell out of bed. We broke below support into a downtrend. Blue professional bars kind of getting short and then picking it up at the lows, and we had that situation where we almost went into what we did for a day and a half, kind of go into negative prices for that expiring contract on crude. But then since then, V reversal, and that's kind of come back up. That V reversal happened though several, a month or so, month and a half after the kind of V reversal in the equities market there. So it's been kind of moving back up after some weakness here with amateur bars. We fell off after that, but then we've kind of come back up, and we've come back up to $50. So crude is part of that kind of inflation or commodities kind of trade. Copper, same thing. Amateur bars in December, we fall out of bed, and then we make that big kind of V reversal. $2 is psychologically a really important price for copper. And that's kind of reversed from there and just been a super strong trade for all year. And then the one I've been banging on about all year, which is DBA. This is the agricultural commodities market that has been in a massive bear market for 10 plus years. Let me just show you that briefly. Pull up the weekly chart on that, and you can see there, going back to the peak in 2008, it's just been down, down, down all the way. But this year, I was saying, this is looking interesting for a bottom down here at $13-14. The year before, the move was led by the amateurs, and then we come back down, and then this is the place where all the professionals got interested. Let's just pull up the daily chart again. Here, you can see, this is one of these stair-step kind of trades here, where we come back up to test its amateur bars at this point here, and that's under the lip, and we kind of come back down. Now we've got stair steps kind of coming this way, blue professional bars down and down, and they've been buying that weakness at that point. And so when we break above that trailing stop, we're in an uptrend now on DBA. And they just wanted everything. The pros step in here, just bought everything. This is way down on what it's been, and so they just bought everything in the stack for a period of a month and a half here. And then stair-step trade here happening a few days ago. Market sells off a little bit. The professionals step in. The trailing stop comes back up. Bang. That's a good trade. As soon as we're breaking above the highs of that, that's good for a long trade. You can keep your stop really tight underneath this trailing support here. So that for me is on the macro kind of global assets kind of side of things. 2 or 3 stories going on. Risk on, risk off kind of trades with equities and bonds. We've got the inflation trade that's starting to really wind up. And on the DBA side of things, we've had a series, a whole year, the whole 6 months, we've had good setups happening in There was soy, there was wheat, there was corn. We also had coffee, cocoa. So there's been one trade after another in that DBA kind of sector, and I think there's just going to be more and more as that gets really interesting over the next year or more. And then lastly, let's talk about Fed printing. So this is gold. So gold, obviously been long-term kind of in an uptrend for a year and a half, but this is when things really got interesting, and this is when the Fed kind of stepped in. We had the equity market sell-off, we had the pandemic kind of come through, and you could see the response by government was just massive debt, massive money printing, MMT, and so on. And that was the point at which the professionals said, "Yep, I'm buying $1,500." And we've rallied kind of since then. It's kind of come off a little bit in the last several months, kind of weak here, but everybody knows the story in Bitcoin, which has just been powering ahead. And I think we're up at today, on the Sunday, we're up at 27,000 maybe on Bitcoin. Again, there we go. That was February, March in Bitcoin. The sell-off down to $4,000. Whole bunch of blue professional bars stepped in. So the choice on that kind of Fed trade seemed to be Bitcoin rather than gold, but gold's still kind of done well over that time period as well. But really, this has been a Bitcoin kind of year. So that's the story there. On the other FX charts, there's kind of interesting patterns kind of going on. There's the usual in and out of the dollar. As soon as there's trouble in paradise, people kind of run to the dollar, and that's what we had in February, March here. So as the market weakened and people realized there was a real problem, they kind of rushed into dollar. It's the panic trade where you panic into US bonds, and that causes that spike into the USD. And then as soon as that V reversal's over in equities, we've just had this continued downtrend in dollar index. Last time we came close, another stair-step trade here. Blue professional bar kind of come in, the trailing stock kind of comes down, an opportunity to get short in the dollar index at that point there. So that's dollar index. We also saw the same kind of trade in Swiss franc. So as soon as the problems in the equities markets kind of came, everybody rushed to the Swiss franc, and we had that spike in the Swiss franc and then the sell-off. What was a little bit different this year was the euro market. So the euro market had become a carry trade currency, whereas previously it was viewed more as not emerging markets currency, but a risk-on type currency. So you'd normally see weakness in the euro when the equities markets kind of fall apart around the world, but instead we saw the euro market actually strengthen over that time. And again, because the euro was a currency that people were borrowing in order to play risk-on type trades. As soon as those started to get margin calls and so on, the money runs back into, in this case, the euro. It's a similar pattern that we'd normally traditionally see in the Japanese yen, but we saw it. I don't know if this is the first time, but it's the first time I noticed it significantly, because I was surprised how strong the euro got during that kind of sell-off. And then the Japanese yen on the other side. Again, that's kind of typical of what you'd see in the in a sell-off in equities. You'd see reversal of the carry trade in the Japanese yen, and the Japanese yen strengthens really strongly. What's interesting for me is the last couple of days we've had this blue professional bar and the Japanese yen kind of come in. So are we just testing back up? This is kind of under the lip, and we're going to, if we fall through the lows of that blue professional bar, kind of go short in Japanese yen, or we are going to bust through 974 at this point, and it's a change in trend in Japanese yen. I'm actually long Japanese yen at the moment, but I'm quite happy to reverse out of that trade and go short if we get weakness in the next few days, few weeks in that. But on the shorter time frames, it's looking like it potentially could get through the 97. So I'm open-minded on that, and we'll see which way that breaks. But then you go to the normal kind of risk-on type currency like the Aussie dollar, Canadian dollar. There's that waterfall decline that we had, the low being made, and it's just been powering up. Interestingly, on the Aussie dollar, Rambo patterns at the moment into these highs. So just a word of caution there. And Canadian dollar, which has traded side by side with the Aussie dollar over the last year after that waterfall decline, we've got a blue professional down bar here. So those two together is worth watching, the Rambo pattern and the blue professional bar, and see what happens there. So there we go. Just a quick run around of the Forex charts and the asset markets to see what's kind of going on there. I think next year what's going to be interesting is this DBA trade. So all of those kind of commodities, particularly the ag commodities markets, and we could start to see real changes in trend, long-term trends being set after the lows being put in potentially this year. So that's going to be interesting. Obviously, do we continue to see strengthening of the Bitcoin market where it kind of really starts to not scare people but surprise people? I think the market cap now is about $500 billion. We hit that today, Sunday. I think that was the headline news, so that's pretty important. And as soon as that goes to $1 trillion, that'll get everybody interested in terms of professional markets. Anyway, so there we go. That's a quick rip around the global macro charts, and let's get into the rest of this. The interesting thing for me going through these kind of notes that I put down is that they're all to do with psychology. And years ago, I used to poo-poo kind of trading and psychology and say, why do you need to worry about trading psychology? If you've got a good system, if you've got a good indicator, got good signals, it's like, just take your trades. You don't need to worry about psychology. And I'd continue to get emails from people saying, yeah, but what about, dealing with the ups and downs of trading and dealing with the risk and the drawdowns and so on? How do you deal with that? And I'd kind of just shy away from it all the time. And it's just interesting to me when I look at these notes, they're all to do with the psychology of how you kind of approach life in a way, but also your trading in a way. So let's get into it. There's some things that I'm not going to talk about because these are triggers right now, and they're not important when it comes to day-to-day trading. So let's get that kind of out of the way. Years ago, I used to rant on about the Fed and the large players and the investment banks and the privileged, people that were protected, rant on about market manipulation and so on. And people would love those videos, and they'd email back and they say, "Yeah, keep it up, keep it up." But in the last 2 or 3 years, my rants have become a little bit more political. I've not ranted about pandemics this year, but this last year. But they just turn some people off because they're triggered. So I'm not going to talk about any of the things. Not even going to say these things, because even if I say 1 or 2 of these words, your video gets cancelled or whatever. But just to say, if you're triggered by any of these things, recognize that that's psychologically not a healthy position to be in. I find it easier just to step back and just kind of float a little bit above the issues and just kind of look down and observe rather than being kind of in the weeds. Difficult to do, but it's a suggestion. And then for me, I keep on saying year after year, I've underestimated this, and I keep on learning my lesson, and yet again another year kind of comes along where I learn my lesson. I am stunned by how far government will go, and we've allowed government to go. It's just extraordinary to me. And so I'm not going to be caught out next year. Not that I was caught out particularly this year, but it's just the creep of government power and totalitarianism that we are allowing as a society around the world. And it's kind of scary to me. In the markets, it was all started, with Fed policy after 2000, where they were basically just trying to eradicate the business cycle, where just smooth it out, make it easier for people. Let's not go through these big kind of ups and downs. Well, the ups and downs are important. And you get this situation where you find it impossible to normalize rates because so many people will be hurt. The larger and larger, the imbalances become with our resulting excess debt, is that you can't normalize interest rates. You can't bring it back because, the damage you will do because of that. Much rather have a dozen small earthquakes than one, catastrophic 1906 in San Francisco type thing. So get the problems out with little kind of corrections rather than one big correction. But we refuse to do that. And then comes global financial crisis 07-08, and there's some institutions that should have failed, but they're too big to fail. And we protect some moneyed interests and some people that should have been creatively destroyed, and we would have come out of it stronger, but no, we didn't do it. And then after that, we go through quantitative easing, which I keep on reminding people. Back in the day, some 10, 20 years ago, we called the nuclear option. If everything went to hell in a handbasket, then we would do QE. Well, QE now is a day-to-day phenomenon, and it's just stunning to me that we have accepted that. And again, another fringy kind of thought, universal basic income and modern monetary theory, which, a year or two ago was viewed as pretty edgy type stuff. Well, we've just introduced it this year, and so, it's in play, and no one's particularly, complained about it. And said it's a problem we shouldn't be doing. There's a couple of voices in the wild about that, but not many people. So there's no stopping us now. We will just kind of continue on, and I dread to see how far government will go next year, but just wait and see. Again, float above the problem and kind of observe rather than kind of get all uptight about it. When I have discussions with my nephews, I always say the three most dangerous words in the English language are the government should ... And as soon as you say that, you're kind of asking for higher taxes, totalitarian government, just overreach by government and so on. But I don't see it stopping, particularly next year. And I say these things because I'm a libertarian at heart. I always find we're kind of fighting the markets and Mother Nature. I think the Greeks had it right in their philosophy of Stoicism, where it's like, bad things happen. You just have to, you can't stop bad things happening. You can't stop or shouldn't stop recessions and depressions, the fact of life. And you can't stop, ill health and death. It's sad, but it's a necessary part of life. And ultimately, the markets and Mother Nature will win. I'll replay that part of the Jurassic Park movie where Jeff Goldblum is in with the scientists, and they've just shown him the baby dinosaurs that are all female. And he says, well, what about the males? And he says, well, no, we're not going to breed males, because then we'll have problems if we breed males and females. We won't be able to control it. And he looks at them and says, but you can't stop them. Life finds a way. And I think that's just so right. We're trying to fight Mother Nature and the markets. And I don't know, my gut feel says that's not going to work. Can you stop a virus, and can you print forever? We'll find out. Anyway, so more about the psychology of 2021. I think there's going to be some themes during the next year. One is going to be the interplay between the people who want to get back to normal and the government who will try and slow it down. What are the new normal rules going to be? We're going to get this popular pushback against those. There'll be people that want them, there'll be people that don't want them, and I think we'll go through a year of stop-start, at least a year of stop-start on all of those things, and we'll see different countries moving at different rates. So I think that whole question of speed of normalization is going to be a big psychological issue that's going to play out all year. The other one is the sad thing. I think we'll see the full magnitude of the economic fallout next year. For some reason, it's been masked this last year, and I don't think the magnitude of the support that has been given to people and businesses has really been enough to help. And I'm surprised we don't see more stories about the economic fallout. I think we'll see those stories, and people will really will be hurt next year. I think we'll have bankruptcies and evictions and unemployment. And for me, the saddest thing is the lack in confidence. When I look around my friends and the people I talk to, there's a real split 50-50 into people who've been psychologically damaged, that they have lost confidence and they are scared and they're hunkering down, and others who are like, enough's enough, let's get on, move forward, blah, blah, blah. So, which brings me to the third point. There will be transformation opportunities as we go forward. They're happening this year, and they will just continue to grow next year. The remote working, solutions to that, the online learning, solutions to that, and the damage to higher education that will do. And then everything to do with health, because people will be switched on more about their health, hopefully. So those are going to be opportunities going forward. But as I say, ultimately, none of those things matter. What matters is your trading. So some friendly advice. We've had a good year, Mrs. Emini-Watch and I. Yes, we have definitely had our challenges and difficulties, but we've come out of it well. And one of the reasons I attribute that to is at the beginning of the year, so in January 2020, I took a good look at where my trading was and where I wanted it to be, and I realized I was just taking kind of incremental steps, and the steps needed to be bigger going forward. The reason for that is I loved day trading because I would be flat at the end of the day. I think 07, 08 psychologically kind of scarred me, the huge kind of swings that I just liked day trading because I could be flat at the end of the day, sleep easy, not worry, and I'd say just focus on the first hour or two of the market and just don't worry about anything else. And being flat is psychologically, it's very, so flat, by flat I mean it's like you've got no positions on. So you've taken your trade, you're in and out, you're done for the day. And I like the psychology of saying, look, treat it like a job. You're trying to make your salary each day, your 4 points or whatever your target is. As soon as you've done that, stop for the day, rest up, come to it fresh the next day. Psychologically, that's a nice way to approach the markets. But in reality, it was only getting me so far in terms of my objectives, in terms of, net worth, balance sheet, and so on. And so when I looked at that and how old I am and what I want, where I wanted to be in the future, I realized January last year I needed to be taking more risk. And so I started trading more like a mini hedge fund. And for me, that was less day trading and more swing trading. So day trading, just for those who don't know, you're kind of in and out in minutes or hours, and you're done at the end of the day, flat for the day. Swing trading is more 2-3 day to 2-3 week kind of holds. And I started trading futures, all of the futures, not only the E-mini, but also the Forex futures and the commodity futures. The year before in 2019 and before that, I've been trading leveraged ETFs. And because of some kind of problems with domiciled accounts and so on, I wasn't able to do that anymore. So I switched those trades into futures trades instead. Had various rules for doing those trades, maximum of 3 positions. I'd taken maybe an E-mini position, a Forex position, and a commodity position at a maximum, and only ever have 3 trades outstanding, no more than that. And be extremely disciplined on stops and keep the stops pretty tight. And also increase my risk level. So I was kind of dialing up the risk. I'll talk about that in a future video. So that's been good, and that's worked extremely well this year. So I've had a good year in terms of trading. In the background, I've been fortunate enough to be long Bitcoin since 2016. And so that's been a good trade. This year, it's been a Forex trade. Over the whole hold, it's been a 10x trade on that position. So that's just been nice to have in the background. That's been going well all year. So psychologically, that kind of helps go with you. As does, the real estate market in Australia didn't fall apart. And so again, that's a psychological thing that just helps. That's kind of gone your way, and so it's not a worry. The biggest mistake I made, though, I went to cash in my retirement account in January 2020, on the 20th of January, and that was superb timing, but I didn't buy back in. So there was one point back in kind of mid-year that was a perfect entry point, and I didn't take it. It's not that I missed it. I think I swung traded on E-minis and so on, but I didn't do it on the retirement account, and that was a mistake. So that's kind of to do with the nuts and bolts of trading, but there's another aspect which is kind of dealing with psychological stresses of what's happening at the moment. Because I see 50% of people not necessarily thriving but coping. But 50% of people are definitely stuck. This is how I'm coping, and maybe some of these comments will kind of resonate with you. So first one is coming to the realization that, I wish the world were different, but it's not. This is the cards we've been dealt, and you can spend a lot of time stressing over how things should be different, what the government should do, and so on. And to some extent, that's useful, but it's also wasted energy. Just be aware of that. Rudyard Kipling in his poem, If you can keep your head when all about you are losing theirs, I think that's right. You need to be an observer, if you like, of your own reactions to what is happening. The second kind of coping mechanism is what some people call, viewing the world as a simulation. I'm not sure I'm totally up for that, but it seems to me more and more as I get older that the world is fucked up by design. It's not supposed to be perfect. Peaches and cream, sunny days every day, no problems. It's not supposed to be like that. It is, therefore, supposed to be messed up, and it's a test. It's kind of a game, maybe, for you. And so it's about your choices that you make. Some people are thriving, some people are paralyzed by it, but it comes down to your personal choices and your moral choices. But floating above what's going on and kind of just observing sometimes is helpful, rather than living it too deeply and getting caught up in the details. So just float above it. And then the last thing is focus on what you can do and you can control. So your mental attitude is number one. Your health, particularly, that's important with pandemic kind of raging. It's like look after yourself, look after your immune system, exercise, eat well, breathe. And for me, surf, get in cold water, get in saunas, do all of those things to improve your immunity, and then chase opportunities. There are opportunities to be had. Don't sit back, and the worst thing would be to look back in 3 or 5 years' time and say, I did nothing for these 3 or 5 years. I just kind of spun my wheels and just sat in my house and just worried. So, lastly, we've made some changes on Emini-Watch, and I've not talked about this, although they've been kind of in the works for a couple of months. First of all, on Emini-Watch, on the website itself, the blog has been deleted, believe it or not. I can't believe there's so much work over the years went into this, but 1,264 blog posts were actually deleted. And what I did instead was to replace those with the YouTube videos on the site. So you can watch all of those YouTube videos on the site. If you go to Emini-Watch now, I'll just pull that up for you, and you go under the menu and you look under Trading Blog, you will see there you go, all of the videos on YouTube are then kind of pulled in to the Trading Blog on Emini-Watch. So that's a change that we made on the site. We've kind of replaced all of the content that was there with the YouTube videos. To be honest, all of the content's in the videos anyway. The interesting stuff's in the video. There was nothing in the commentary particularly that was of interest. And so what that means is now is the website only has the best content, and there's only 50 pages to the website, which is kind of a huge change. So if you go to the sitemap, you can see exactly what's going on. The key pages are the one to do with how I day trade and all of the articles that are related to that. This is basically now the best of the best on Emini-Watch is all there. So you can find all of those, the indicators, the free stuff kind of here, but it's been slimmed down to only 50 pages, which is hopefully easier to get around. And so if you're looking at the site, then I encourage you to use the sitemap to get around the place. Use the search buttons. Those are available kind of here. You can look for anything there. Let's look at tick charts, for example, and that'll pull up the best kind of articles on whatever you search for. And lastly, we put in breadcrumbs so you can see for each article where that article sits in the hierarchy, the structure of the website. What I'm trying to get people to do is to use the YouTube videos to watch the updates rather than necessarily come to the website. I'm sure come to the website, watch the videos there, but YouTube has improved their video hosting immeasurably over the last 3 or 4 years. There's a couple of things that I really like about it. You can watch me at double speed, believe it or not, so you can actually kind of get through a video in half the time and listen to me. And I don't sound like a chipmunk when you do that. So they've done some clever stuff on that side of things. There's also closed captioning. If you want to watch like that, there are translates. I think you can translate into languages kind of automatically. The videos are in high definition, so you can watch them, kind of the charts pretty clearly there and get notified as soon as videos are up. So I'm pushing more people towards the YouTube to kind of keep up with Emini-Watch on the YouTube side of things. And then lastly, plans for Emini-Watch in the next year. Finally, the 10 Days to Better E-mini Trading is being retired. That content now has gotten a little bit kind of old. It's over 10 years old, so that's going to be pulled off the site shortly. And in the next few weeks, I'm going to put together a series. Maybe it's going to be called something like Better Trading with the Better Indicators. I'm not sure yet, but it'll be a similar kind of 10 days series. But it'll be 10 days to teach you how to use the indicators. And so then the next phase is for the website to grow in this direction of how to run your own mini hedge fund. I'm doing it with futures, but you can do it with ETFs or leveraged ETFs. You could also do it with micro or mini futures. So there's various ways of having different size accounts and managing your money as kind of a mini hedge fund. And I think the first video I'll put up on that topic is about risk and position sizing and how I happen to be doing that with my trading at the moment. So that's about it. Long video, apologies for that. Hopefully some of those thoughts are of use to you. As I said at the beginning of the video, I do hope you are doing well. And let's all look forward to 2021 and make it even better than 2020.